All right, so this is lesson number 12 from your finance unit. It says here, as an investor, it's important to know how much risk you're willing to tolerate and when investing your money. This is called risk tolerance. And again, I apologize for my handwriting. It says here, if you want a higher rate of return, then you need to accept a higher risk. So risk refers to the potential of you losing some or all of your money that you've invested. Now, a portfolio is all the different investments that an individual or organization holds. So to reduce the risk of your investment, you should choose a mixture of the investments so that if some do not do well, they can be offset by the ones that are doing well. This is called diversification. So diversification. If you hold a diversified portfolio with a variety of different investments, it's much less likely that all your investments will perform badly at the same time. So moderate risk investments have a higher rate of return than a savings account because they are riskier. So the first one is a mutual fund. Now, what is a mutual fund? Well, a mutual fund is just a collection of investments such as stocks and bonds and other funds owned by groups of investors and are managed by a portfolio manager. It allows us to invest in a variety of stocks, but only purchase one fund. And if you're more interested in this, you could click this or actually type this link in. Now, it says here, how do they work? When you buy a mutual fund, you pool your money along with other investors to purchase units or shares of a fund. And the portfolio manager uses the money to buy and sell stocks and bonds and other investments depending on the objective of the mutual fund. The profits are then returned to the shareholders monthly, quarterly, or semi-annually in the form of dividends. So whatever profits are made, they pay you back. Now, what are the advantages? Mutual funds allow for small or individual investors to access diversified, professionally managed portfolios at a low price that are normally only available to large investors. Mutual funds can earn dividends if a stock owned by a mutual fund pays a dividend, which are paid directly to the shareholders. If you hold a mutual fund in a registered plan like RRSP, which is Registered Retirement Savings Plan, or RESP, which is what's called Registered Education Savings Plan, you won't have to pay tax on the money until it's withdrawn from the plan. Now, the disadvantages. Well, they're not guaranteed, meaning if the values of the mutual funds go down, you could lose your money. You don't have an option to customize the holdings of a mutual fund, meaning you are stuck with that fund the manager chooses. All right. So if you want to do Bitcoin, you can't get Bitcoin if he's or she's into bank stock, for example. Okay. Capital gains. When you sell your mutual funds for more than you paid for it, you'll have a capital gain. If you sell your mutual fund for less than you paid for, you have what's called a capital loss. Distributions. Depending on the type of fund you buy, you may also receive distributions of dividends, interest, capital gains, and other income the fund earns on its investment. You can choose to receive distributions in cash or have them reinvested in the fund for you. Unless you ask for the distributions to be paid in cash, the mutual fund will usually reinvest the distributions for you. So basically, if your mutual fund makes money in terms of cash, they'll just buy more funds unless you want cash. Okay. So the types of mutual funds generally your parents, adults will invest in are what's called money market funds. Those are super duper safe. Fixed income funds, those are stocks that are generally into companies that own rental properties. And what happens is if you own rental property, you rent apartments or you rent square footage in a high rise, for example, and then you receive rent income. Equity funds, those are stocks like Tesla, Microsoft, Royal Bank, stuff like that. Balance funds is a mixed mash of all the first three. Index funds are funds that match what's called the Toronto Stock Exchange, or what's called the S&P 500 or the S&P 60. Funds of funds is slightly unique. I'm not super familiar with it, so I'm not going to bother explaining that to you. Now, when you get old enough, what happens is, and you start wanting to plan for your future, where can you buy mutual funds? Banks, credit unions, life insurance companies. There are mutual fund dealers, kind of like a bank, except they don't actually have cash in their office, and designated investment firms. Okay. Now, there's other types of assets you can buy. What's called exchange traded funds. Oops, sorry. An exchange traded fund ETF is an investment that holds a collection. Oops, where's my pen? Of investments such as stocks and bonds, similar to mutual funds. Okay, it's owned by a group of investors and managed by a professional money manager. And if you're interested, you can type in that link, and it'll give you a little bit more information. Now, what are the differences? First, mutual funds are what's called actively managed. That means someone's paying attention to the stock market every day, every hour, watching it go up and down and making certain purchases and selling. Meaning there's a portfolio manager and a team of analysts actively buying and selling securities or stocks and bonds. That's just a fancy word. An ETF is not actively managed. It follows a pre-existing index. This means that an underlying asset of ETFs do not change much. The makeup of an S&P 500 ETF is not going to change much over time. Now, the S&P 500 is generally technology stocks. So, like I said, Hewlett-Packard, which is HP, or Compaq, Microsoft, Apple, Google, Alphabet, all those types of things, okay? ETFs trade on a stock exchange. ETFs typically have lower fees than mutual funds because it's not actively managed. No one's really paying attention to it. And it is easier to keep track of underlying assets in the ETF since they do not change as much as mutual funds. Now, ways to make money from ETFs. Some ETFs pay out money made to investors. These are called, again, distributions. For example, you may receive interest if it's like a bond, dividends if it's an actual stock, capital gains distributions if the ETF sells an investment for more than it paid. So basically, if you sell the ETF and you've made money because it's worth more than what you bought for it, then you get capital gains. Now, unlike many mutual funds, ETFs do not reinvest your cash distributions in more units or shares. Here's what happens when you're with your distributions instead. The cash stays in your account until you tell your investment firm how you want to invest it, or you may have to pay a sales commission on what you buy. Your investment firm may offer a program that automatically buys more ETF units or shares for you. You likely won't pay sales commission on these automatic purchases. So there are systems in place where automatically, if you get a dividend, it'll buy more units. Now, again, different types of ETFs similar to mutual funds. Okay, I'm not super duper familiar with it, so I won't bother trying to explain what those are. If you're interested, please look them up. Now, this is the most interesting though, stocks. A stock is a share of ownership. This is what most people envision when they invest money in the stock market. Ownership in a company. This means that you actually own company stock. You are you own a percentage of the company itself and are entitled to share the profits. And you can vote on how the company is run. So you can vote for the president, the CEO, the vice president, chief financial officer, all the big positions. You can actually vote. Now it says here, when you buy a stock, you're buying a piece of ownership of a company. A bond, however, is like a loan or a debt. So you're giving money to a company and they just write you a IOU. All right. A bond is a promise that a company makes to pay you back the amount that you lent them plus interest. Hence, if you own a bond, you are only lending the company money. You don't actually own part of the company itself. Okay. So for example, if a company issued 1,000 shares and you own 100 shares, that does not mean that you can go to the company headquarters and take 1/10 of the furniture. It means that if the company is profitable and if they made $100,000 and decided to pay it out to the shareholders, you get 1/10 of that $100,000, which is 10 grand, which is pretty sweet. You want to invest in a company that you think will be profitable with the hope that the company will start paying out its profits to its shareholders. Okay? Bitcoin is not a company that pays out profits. Whereas if you bought a stock in Ford, for example, or Mazda, or Audi, or even BMW, at the end of the year, once they make money, they will pay that money back to its shareholders. Now, ways to make money from stocks. Company profits may be divided among shareholders in the form of dividends. Larger profits can be made through an increase in value of stock on the open market. Where can you buy these things? Okay, so investment firms, discount brokerages, portfolio managers. You can buy them through your bank as well, actually. Okay. It says your stocks are traded in an organized market called a stock exchange. So there's a couple of them, Toronto, TSX, Venture Exchange. The most famous one is, of course, the New York Stock Exchange. NASDAQ is located in New York as well, and the London Stock Exchange. There are many more stock exchanges out there. There's ones in Taiwan, in China, all over. Okay, so 4 things you need to place an order of stock. First of all, you need to know what you want to buy. You need to know how much you want to buy or sell, and the price that you want to pay. Now, the price fluctuates second by second. So a market order is stock bought or sold at whatever the latest price is. Limit order is when you set the price limit for the highest price you're willing to pay or the lowest price you're willing to set. The order expires at the end of the day unless you specify a longer time limit. So market order basically is if you put in a price to buy Tesla, for example, and Tesla is crazy through the roof right now. If you say market price, as soon as you hit enter, it's whatever the most recent price is. Whereas limit order says, I don't want to pay the market price. I want to wait and wait and wait until it hits a particular price point that you're comfortable with. Okay. Now, how you want to pay, because eventually when you buy it, you got to pay. So you use the money from your cash account to buy stocks. Now, there's 2 examples of buying. Okay, one is what's called on margin or short selling. Now, again, these are terms that I know what short selling is. Short selling is where I put it in quotations, you borrow someone else's stock. You don't actually own, let's say, 10 stocks of Tesla. Now, short selling is you're borrowing someone else's shares, all right? You haven't paid for them. What you do is you sell it on the stock market. Now, when you sell it, obviously, you're going to get cash, but that cash isn't yours. what you have to do by the end of that day is hope that the value of Tesla stock goes down in price. Because now you have a whole bunch of cash, which isn't yours. If you go back in the market by the end of the day and you buy 10 shares, hopefully the price has gone down. Now, when you buy it at a lower price, you don't actually spend all the money that you've received, so you have a little extra. Now, that little extra, as it turns out, you get to keep because you have to return those 10 stocks that you borrowed from your neighbor or your friend, okay? It almost sounds like stealing. But if you remember, this is February 28, 2021, there was a huge kerfuffle about GameStop. And essentially what people were doing was they were borrowing other people's GameStop shares, hoping that the price would go down. They would go buy the stock at the end of the day, hoping that they can return the stock. And whatever money the difference is, they were hoping to keep. But a lot of people were losing because GameStop prices were actually going up. Okay. Now again, margin, I'm not very familiar with that. So if you're interested, you can look that up, okay? Now, I just want to do a couple of examples with you. It says here, Robin invests $6,000 in an aggressive money market fund. If there's a 5% fee for investing the fund, how much extra does she have to pay? Well, 5% works out to 0.05. Now, if you are paying that as some sort of fee, that means you're going to charge, or you're going to be charged $6,000 times 0.05, which is $300. Okay. Part B says, how much does Robin expect to earn if the average rate of return is 9% per year? And if she leaves the fund invested for 2 years? So this becomes an old problem, which is interest is principal times rate times time. So the principal is $6,000. Okay, we're using the simple interest rate formula times 0.09 times 2 years. That works out to, that works out to $1,080. Okay, so I apologize. I made a boo-boo. Okay, let me do that again. So it's $1,080. Okay. Now, if there's a 6% fee for selling this fund, how much extra does she have to pay when she sells the fund at the end of 2 years? Okay, well now she has, her principal now is, because she bought it for $6,000, she has $7,080 worth of principal, right? Now she's going to pay 5% interest to sell it, because that's the fee, times 0.05. She's going to lose $424.80. Now, how much profit did Robin make from the fund after taking away all the fees? Well, if she made a profit in terms of interest of $1,080, you're going to subtract the $300 fee that she had to pay just to buy the stock, minus the $424.80 that she had to pay to sell the stock. Robin earned $305.20. Now, I know that doesn't sound like a whole lot of money, especially after 2 years, all right? But there are other things that charge less in terms of fees to buy and sell, okay? And the last example that I want to go over says here, Kay Oss invests $3,000 in stock and makes $240 when she sells it. What is her rate of return? Okay, so we'll use simple interest. Now, she made $240. Divided by her initial investment of $3,000. And then we're going to multiply by 100 to convert it into percentage. So this works out to 8%. If there is a $20 commission fee, so we're going to redo the problem. If there is a $20 commission fee, what is her new rate of return? Okay, well, that means you made $240. You got to subtract the $20 commission fee. That means that she only made $220 in earnings. Well, $220 divided by your initial investment of $3,000 times 100, that gives you a rate of return of only 7.3%. Okay, so I hope this sort of makes sense. I'm going to leave assignment 12 for you to do.